Okay guys, time for another week ahead video. This week our video will cover the trading week running from Monday the 28th of June to Friday the 2nd of July. And our main focus points, or one of them at least, in this week ahead will be the US dollar and the upcoming US economic data, which of course includes Friday's NFP jobs report. Now, as you guys know, the US dollar has been a very unloved currency from the middle of last year, and there's been very good reasons for why the market has been so bearish on the greenback from then. Despite a push higher that we had at the start of the year, that was, also mostly driven by positioning. The dollar has continued to push down towards cycle lows really from April, and that downside from April came about despite some of the highest inflation prints in the US that we've seen in many decades. And even though jobs numbers missed expectations, they still printed solid. Now, the reason why the dollar couldn't get off the floor despite better economic data, despite attractive growth differentials, despite vaccination success, was because of the ongoing global reflation narrative at the one end. And on the other end, the more influential one, of course, is the Fed's ultra easy policy stance in line with their new average inflation targeting framework that saw markets discount these positive data points against the US dollar. Now, having said that, before the Fed's June meeting, we actually updated our previous fundamental weak bearish bias on the US dollar to a more neutral outlook, and this was due to a couple of reasons. Firstly, such as the April FOMC meeting minutes showed that members were softening up to the idea of starting to talking about tapering. Another driver, of course, over the last couple of months has been real yields. As we can see here in red, we obviously use tips inverted as a proxy for real yields here, just FYI. Real yields, one of the reasons why we scaled back our weak bearish bias to more neutral one for the dollar is because we thought real yields would really struggle continuing to fall further, especially at the same rate, as we started to see year-over-year base effects for inflation fizzle out, sparking more of that peak inflation narrative downside in something like inflation expectations. And that, of course, was expected to see more of an upside bid coming into real yields. The other one that we were looking at, other drivers, part of our analysis was positioning, where we saw markets once again building up a significant short position in the US dollar against some of the other majors, which arguably meant that a lot of the downside was already reflected in the price. Liquidity is also another factor, with a lot of the expected downside from the Treasury's general account being significantly reduced. We thought a lot of that was already priced into the markets. And apart from that, the other interesting driver was that the expectations for that robust global reflation environment was getting a little bit fatigued with global economic surprises, as we can see here in the City Economic Surprise Index, the global one in orange. That started to trend lower over the last couple of months. And even though we can see that clear inverse correlation between these global economic surprises and the US dollar, which is in blue, that has started to trend down ever so slightly despite some of these recent pushes that we've seen to the upside. So with economic data reaching a potential peak reflation level, that should arguably have meant that the reflation downside in the US dollar should start to run out of steam. Now, that of course doesn't mean that the markets suddenly didn't expect or doesn't expect solid and higher growth and inflation anymore. It simply meant that the amount of upside surprises was diminishing. So that doesn't mean that reflation expectations have gone away, but rather that we've reached a possible peak reflation. And if that is the case, it should mean less downside pressure on the US dollar in aggregate. So all of that was basically before we went into that June FOMC meeting. The dollar, of course, saw a meaningful jolt higher after that FOMC meeting that we had 2 weeks ago, as the Fed's dot plot showed that a very big chunk of FOMC members had a change of heart and saw the numbers of votes for a potential first liftoff in rates in 2023 actually climbing from 7 members back in March up to 13 members in June. Actually now, in terms of the median dot plot, expecting a possible 2 hikes in 2023. So even though this tempered things like inflation expectations, which caused yields at the longer end of the curve to start to drift lower, it actually gave yields at the shorter end of the curve a lift, supporting the US dollar as rate expectations were brought forward. So always remember, when you look at your longer dated yields and your shorter dated yields, things like your 10-year, your 20-year, your 30-year, that'll be mostly influenced by growth and inflation expectations, looking at the economic outlook. When it comes to the shorter end of the curve, like your 1 year, your 2 year, etc., that's normally more driven by rate expectations, basically driven by what the Fed is expected to do next. So even that saw a very bullish reaction, and rightly so, in the US dollar, with the Fed still sticking to their guns in terms of expecting inflation mostly to be transitory, and with there's still a lot of substantial progress required in the labor market before they will look to actually start tapering. It wasn't enough for us to change our outlook for the dollar from neutral to bullish yet, and that means that the dollar's outlook remains neutral right now, in our opinion, from a fundamental point of view, and it will be largely determined where it goes from here based on the incoming US economic data. Now that brings us nicely to the week ahead, where the highlight for the dollar will be the incoming jobs and ISM data, the manufacturing ones scheduled for this week. With the Fed officially opening the tapering debate with that June meeting, we would expect the dollar to trade even more cyclical with that incoming US data. That means that we expect the dollar to trade correlated with economic data, seeing upside in the dollar if we have upside or positive surprises, and negative ticks in the dollar if we see negative surprises, as the data will be scrutinized right now for the markets as a potential gauge for anticipating the pace of normalization by the Fed. Now, even though things like inflation data is still very important, especially now that the Fed in that June meeting have acknowledged that the potential for upside risk is inflation, the main area of focus that the markets will be focused on right now for the Fed is still on the labor market. The Fed has made it very clear that they want to see substantial progress being made in the jobs data before they will take their foot off the QE pedal. And that view is especially true for that three core members of the Fed right now, being Fed Chair Powell, Vice Chair Clarida, as well as Fed's Williams. They want to see a sizable recovery of jobs for that over 7 million people who are still unemployed compared to pre-COVID levels. So all of that just means that jobs data, guys, will be front of mind for markets in the weeks as well as months ahead. Keep in mind that the data we receive going into things like NFP, such as the ADP national employment, such as challenger layoffs, such as the employment sub-indexes for things like ISM manufacturing, all of that will be very important as the inputs for the NFP forecast. So if they see meaningful surprises to the up or to the downside, that will affect what the markets are expecting from that NFP print on Friday. So don't just look at the NFP, always look at the data that we get running into that event. Also, don't just be fixated on that NFP print itself, even though that is where the bulk of the initial reaction will normally come from the market. The recent concerns about labor market supply will also be important to watch, and that means also keeping a very close eye on things like the participation rate, keeping a very close eye on things like the U6 underemployment rate, apart from the normal unemployment rate and average earnings. Talking about average earnings, also in line with that, labor supply issues will be very important to keep in mind. Even though things like higher wages should normally be positive for the US dollar, if we see a real big jolt higher in average earnings, that can actually see inflation expectations picking up, and if that outpaces something like US bond yields, especially at the back end of the curve, that can actually impact the dollar negatively if it starts to push real yields lower again. So that's definitely something to keep in mind. All of that just means don't get fixated just on that NFP print. There's a lot more going on in these jobs reports than just looking at that headline number. That's always going to be your first market reaction, and then as the market digests the information, that's normally when the more sustainable moves will flow out, if indeed there is any major deviations between actual and expectations. So going into that event, consensus right now is expecting a print of 600,000, but again, that will be updated during the week as more forecasts come in with that updated economic data points we get before NFP. Now, even though the dollar has eased back slightly after that FOMC jolt to the upside, the greenback has held on to a lot of the gains, majority of the gains, and have remained well supported this week above key support around that 91.40 and 91.50. We spoke about this quite a lot this week in the terminal. So watch out for the forecast for NFP going into the week as it potentially changes going through the incoming data like ADP, like that ISM manufacturing employment sub-index with expectations of a print close to 600,000. Now, if we see that increase, we would expect that to actually put a potential bid in the US dollar in the run-up to that jobs report on Friday. So that's definitely something to also just keep in the back of our minds as we head towards Friday. And in terms of a potential trading plan, it's going to be very, very simple. We're just going to look at those data points because we think the dollar is going to trade even more cyclical towards economic data points. We're looking for bullish outcomes, meaning prints close to or above the maximum expectations for that ADP, the ISM manufacturing headline, as well as importantly, the ISM employment sub-index as it relates to the NFP. And then we're looking for an overall bullish jobs report, meaning looking at NFP, U6 underemployment, as well as unemployment. If we see all of these coming in positive, we would expect that to see a lift in yield, see a lift in the dollar, which means downside in euro dollar and downside in gold, and the exact opposite because we expect the dollar to trade more cyclical. If we do see any of these prints coming in close to or below the market's minimum expectations, we would expect to see the exact opposite: downside yields, downside dollar, upside euro dollar, upside in gold. Remember, the focus isn't only on these data points themselves, but what the data points could potentially mean for the Fed's policy normalization path. That's going to be the real focus point for these data points, and that's why we think the dollar is going to be extra or additionally sensitive to any major economic data points coming out, especially labor market data. So guys, as always, remember that the potential outcomes and the potential market reactions in this report is merely a guide for what we would expect in the event of the various outcomes, and that the market can always surprise in the way that it reacts. So these types of outcomes and scenarios is basically never intended as a trade call, but rather intended as a framework for you to use in your own scenario planning. So guys, that's everything from our side for this week ahead. It's going to be a light schedule apart from US data, so we do expect the dollar and these incoming data points to be the main focus for the market. So do make sure that you're prepared for that before you head into the new week. We hope everybody will have a fantastic trading week ahead.